In this week's update, US election likely outcomes for markets, the critical need for flexible thinking, and where is the gold price going? My name is Garry Davis, and I'm an authorised representative of Primary Securities. Any advice is general advice only, and your personal objectives, financial situation, or needs have not been taken into consideration. Let's start with a quick market perspective. It was certainly a week of very mixed messages, and as a result, the US market finished down, but it was a bit of a roller coaster along the way. We had the biggest week of earnings for the big tech stocks, and they were mixed. A couple of good ones, Google and Amazon, a couple of ones that weren't received well by the market, predominantly Microsoft and Meta. So that certainly gave the market plenty to think about. Then on Friday, the October jobs report came in as a shocker. It was something like 12,000 new jobs compared to 250 was expected. Those numbers may not be exact, but you get the picture. But look, to a degree, it was justified because there were labour strikes and there was also the impact of the hurricanes. So the market moved on from that pretty quickly. The stock performance remains incredibly bifurcated, incredibly divided. We've got stocks that are just rocketing ahead at a rate of knots, and we've got stocks that are being absolutely smashed. 30, 40, 50% drops in just a day or two. So it's really, really critical as to what you own. You don't want to just own the market in general terms. There are some absolutely outstanding companies in America and in Australia, and they're being rewarded, and particularly in the small and mid-cap space that have lagged for so long. The real key is differentiating between those that have run too far too fast, and that now creates a situation where the risk levels are now excessive, and the ones where it's justified. And it gets confusing for a lot of investors because there are some stocks that are trading on PEs of 20 or 25 that you would consider to be excessive and overvalued. There are other stocks that are trading on PE multiples of 50 to 100 and above, where the market is very, very happy and has been for a long time to sustain those sort of elevated valuation levels. So determining an appropriate valuation, both fundamentally and technically, is not an exact science, and it does require a fair amount of, experience and understanding of how the markets treat different sectors and how it treats different stocks. So it's not just a simple matter of doing some scans and putting in a PE of 20 as your hurdle or whatever it might be. It's far more nuanced than that. And it also requires an understanding of how markets really operate and the interrelationship between markets as well, between the bond market and currency markets and stocks. So it's not a simple, straightforward process, but equally, it's one that's important to get right. Now, the US election, if there's a Democrat win, then the likely outcomes are that the Green Revolution will even accelerate under Harris. She's certainly shown that that's one of her priorities. It's also likely that Infotech will be a winner. She was the Attorney General of California and has got probably significant links to Silicon Valley. So I don't think Infotech is going to be a laggard under a Democrat win. And they've certainly done pretty well during the last Democrat term. US infrastructure is also likely to do well under a Democrat win. Now, if Trump wins, and my sense of it is, looking at factors from all sorts of different angles, a Trump win is probably what the market has at least partly priced in. So if we don't get a Trump win, then the market is likely to react to that. But of course, it depends on what the win looks like. Is it a clean sweep or is it a divided parliament? That remains to be seen. But under a Trump win, I think aerospace and defence stocks should do better. Clearly, domestic manufacturing is going to get another leg up under a Republican administration, and also construction. It's not exactly lagging out of the Democrats either, but Trump is just so outspoken about bringing manufacturing back to the domestic scene. There'll be reduced regulation for the banks. That will be a positive for that sector. And Trump has also been very clear that he wants the US to be the dominant energy producer in the world. So that should be pretty good for energy stocks as well. And it's likely that tax cuts are likely to be more than less. And then, of course, that has the consequence of, well, what does that do to the government debt level? What is that then? How does the bond market perceive that? What does it do to the currency? It's not a predictable picture. And let's face it, Trump is not a predictable person. So it's a lot of unknowns about the impact of the US election result. Probably the result that will be best for the market is that we've got a divided government. So it's not a clean sweep. That always is good for stocks, which tells you something, because it's saying that people don't trust politicians if they've got too much power, and that the market would rather see not a lot get done. And that's actually positive. So it's perhaps a bit of an indictment on the way that Western democracy works. Either way, it would appear, whether it's a Democrat or a Trump win, either way, housing is probably going to do pretty well, because both parties have got strong policies around developing a lot more land, building a lot more houses. So that should be a good sector. So this is a little bit of a guide, but look, I'll have more to say on that at the end of this video. Now, looking at gold, the big picture for gold, so looking at over the next few years, geopolitical tensions, it's hard to see them going away. Again, irrespective of what administration is in Washington, I think the geopolitical tensions are going to continue. Russia, China, North Korea, Iran have made their positions abundantly clear, and that presents real problems for the West. We've got central bank buying is almost certainly likely to continue because of the deteriorating trust in the US dollar or US government policy, particularly under Trump. Then, of course, we've just got the economic reality of massive and rapidly increasing debts in the US. What is that distortion? What impact is that going to have on stability and therefore the gold price? But you've got to say that the bigger picture is positive for gold. And you would expect that the gold price can probably move higher if you look out over the next couple of years. But if we look at the shorter term, we've currently got a rising US dollar, and it's very difficult to determine what the US dollar will do under a different administration or the same administration. We've got rising bond yields at the moment. Is that temporary? Will that turn back down again? Or are bond yields not behaving as everyone thought they would? And also in the shorter term, gold and silver, it's just a little bit technically stretched. So reasons for short-term pullback, probably modest, but the big picture still looks pretty good. All right, now, just before I move on, we strongly advise that you obtain your own investment, financial, legal, and any other advice, because you can lose money in the market. It's actually quite easy to do. And that's one of the purposes of this Sunday video, is to help investors with perspective and just an overall view of the things that do work in the stock market. All right, now let's turn to the American stocks. The NASDAQ was down 1.4% for the week. The NASDAQ just a little bit more with all that toing and froing with the big tech majors. The Russell was flat, so small caps outperformed. Big tech earnings were mixed. As I said, Google was positive. Amazon was received very positively, up something like 6%. But we had Microsoft was down on concerns about growth in their cloud business, and Meta was down about concerns for just the amount of money they're spending on CapEx for AI, which has been a bit of an ongoing theme. So some positives and negatives. The poor jobs report on Friday was saved, if you like, by really good results or well-received results from Amazon and Intel. And it's probable that the jobs report, being as poor as it was, is just a one-off, because they're hopefully not sustainable triggers for that. If we look at the US market year to date, the three sectors leading: utilities, which tends to get forgotten a lot, finance, and also communication services. And they were all up sort of 24, 25% year to date. So they've been the leaders. Not far behind that has been technology. The US dollar was unchanged at 104.32. The yield continues to edge up, the 10-year yield up to 4.4. And the VIX index is up around 22. Let's go and look at some charts. Here's the S&P on a weekly basis. We had little bit of selling the prior week, closed well off its lows, but a little bit more concerted selling around particularly Amazon and Meta. And there was also a few other disasters as well. A company called Supermicro has been absolutely slaughtered on a number of governance concern issues. So that's the S&P, but look, we're still forming higher highs and higher lows, and all of the moving averages are still moving very strongly to the upside. And the value of the index is above all of them. So you can only look at that chart and say that's a very bullish orientation. It's just the short term might do, depending on the result of the election. There's the Nasdaq. We got up to a double top and we backed off just a little bit, but nothing terribly dramatic. Importantly, semiconductors were down a little on the week, but again, nothing dramatic there. That's just doing a consolidation after a very strong run. We've run from 90 to 280. That's an extraordinary rise, a tripling of the value of this ETF. So you would have to expect after that we get a period that could last 6 or 12 months where we get a consolidation. And that consolidation at the moment is setting up as between 200 and 280. So this might just continue in a broad sideways volatile band for some time. If we look at the relative comparisons over the last month, the banks have done well and turned back up on Friday. XLC, which is communication services, similarly, so they're the ones that are still leading the way. XLY, consumer discretionary, had a big surge, but that was because of Amazon, because that sits within that sector. And then we've got technology, so that pretty much reflects what I was saying before, and that all the rest are well and truly lagging and trending down. So that's the setup on a sector basis, but depending on the result of the US election, there is going to be, I think, potentially different set of sector winners and losers. The election outcome will have a bearing on that. Just while I'm here, let's look at Australia. We got a rebound in information technology. Now that has done really well. The big plunge was because of WiseTech Global, the very well publicised events around WiseTech Global. And the rebound in the last week has also been a lot about WiseTech Global. Frankly, I don't trust it, but that's where we are in the short term. Turning down, pretty much everything turning down on Friday with the exception of the energy sector. Healthcare also turned down. CSL copped a bit of selling last week. And then we've got small caps and materials and then finance and information technology. But mostly Australia, you can see most of the sectors had rolled over last week. Just one final chart. This is the Nasdaq 100 versus the S&P. So pretty much going in a sideways fashion. I'll just check in quickly on the currencies. So the currency is still moving a little bit higher, flat last week, but we're still in this band between 100 and 107. So not much change there. The Australian dollar did come off more last week than the US dollar, because the US dollar was flat, but our dollar came down. And I think part of that was the fact that iron ore was a bit weaker last week also. Let's move on to the Australian market now. Our Aussie dollar, 64.9. Our index fell 1.1% on the week. Pretty hard to tell where it goes tomorrow, but we'll see. Friday finished well off the lows, and that's probably the best spin that I can put on it, because it was down, but it was down about 1% early and managed to recover about half of that. So there was not wholesale selling in the Australian market. It's just the sentiment reaction to what you get when the US has a down session. So it's probably more likely than not that the index will make some gains on Monday. And for a change, energy and materials led the way. Haven't been able to stay that very much in recent times. Let me just go and check on those charts. So the ASX 200 on a weekly chart, it's not terribly emphatic, is it? We closed off the highs, we closed off the lows. It's really after a week of, or a period of some 10 weeks or so, that were predominantly up. It's just the sort of bit of profit taking pullback that you would expect. There's the silver chart weekly. So we've broken out very nicely, but the market wasn't having any of that, and we pulled back again to retest that breakout. On the one hand, that's normal, retesting a breakout, but this is rather emphatic looking candle. If we look at this on a daily, you can see we did get some concerted selling on Wednesday and on Thursday. So pretty important for silver to start to turn back up again for this trend. You wouldn't want to come too deeply back into this range here. I wouldn't want to see the silver price below 31. The US dollar gold price on the week was down just a fraction, but after setting all-time highs at $27.90, so almost to $2,800. So that's a very strong trend. But as you can see, when it runs for a period of 5, 6, 8, 10 weeks, you either get a sideways consolidation or you get a bit of a pullback. So we've had a great breakout move. Then we got about 7 or 8 weeks of sideways, and then we took off again. If you look at that, you'd have to say that we're due. Now, whether that comes back as a deeper retracement, let's say back to under 2,500, or whether it does what it did here, which is just essentially go sideways in a little shelf, that perhaps with the lows being somewhere like 26.50, something of that nature. So it could well be that we might have $70, $80, we might have a couple of $100, but it's pretty clear where the trend is. And if we look at it in Australian dollars, then we finished at 41.72. So that's very profitable territory, even for some of the higher cost producers. GDX gapped down on Friday with the pullbacks in gold. And if we look at GDXJ, similarly, breakout, retest, but the retest is actually run a bit further than that. So things still not terribly buoyant. And if we look at the relativity between the gold price and GDX, so this is the Australian dollar gold price and the GDX listed in Australia, then you can see we're not getting the leverage effect that you normally get of a rising gold price. And that's because the costs are still an issue for a lot of gold producers. So gold was down 16 to 27.36, 41.72 there. So I've been through most of that. The ETFs for gold have seen inflows in the last 6 months. So that's a positive because we've been seeing outflows for most of the last couple of years. Some of the local gold stocks here have put in exceptional performances, but they're more the exception than the rule. There are more gold stocks, gold developers particularly, that are not moving than ones that are. Most are struggling, especially some of the global majors. And we got a very poor result from Newmont with production down by 10% and costs up by 10%. That is a very bad combination. So that's one of the reasons that the GDX and GDXJ ETFs are struggling, because of the impact of what's happening with some of the bigger producers. So the free cash flows are just not arriving in the way that normally happens because of the cost inflation in the industry. So you've still got to be a bit careful. This is not going to be a tide that's going to lift all boats in the precious metal sector. You still need to be very discerning about what you own. But having said that, there are some stocks that are doing outrageously well. So that's the good news. Copper didn't do much. Nickel was at 721. Crude oil fell again across the week, down, I think it was 72 last week. We're back down to 69.5. And we've got very critical support at 66. Now, if we look at lithium, the current status looks absolutely awful. And so that obviously sets up the question, is it so bad? Is all the news just so disastrous that we're close to the bottom? Because that often happens. I don't know the answer to that, and I can see some very mixed signals as well. And if you look at Pilbara Mines, there's mixed signals coming from them. They acquired Latin Resources for $560 million, so you would construe that as a very positive move with a long-term view. But they've just put one of their 2 processing plants on care and maintenance. So in the short term, they've got a rather negative view. They're probably borderline whether they're making any money or not at the current prices. So very different signals from Pilbara Mines depending on the time frame that you're looking at. They've still obviously got a vote of confidence in the long term by making acquisitions, by seeking to raise their production rates in WA up to 1 billion tonnes. The spodumene price that they achieved fell 18% quarter on quarter down to 682. So this really is getting very marginal even for a low-cost producer like Pilbara Mines. And then, of course, we've also got Rio that has done a similar thing to Pilbara, and they've made a big purchase in buying Arcadium. So again, that's a positive long-term view. And yet BHP has been very clear that they just do not see the economics around them entering the lithium market. So I don't know whether this is the bottom or not. I think the important thing here is that you need to be guided by the chart patterns. I don't think this is an environment where you could make a comfortable long-term investment in lithium. I think you would need to be guided by the charts. Now, if we look at uranium also, the long-term fundamentals around uranium appear strong, and they've appeared strong since around 2019. However, the spot chart is also looking rather shaky. So tactically, you might want to think, if you've got exposure to lithium, you might want to think about having some stop losses in the market around uranium. And that's the reason why. This is the spot price chart for uranium. Now, I know that it's not representative of what's really going on in the industry because most of the price discovery occurs through contracts, but the spot price does play a part. You can only look at that chart and say we continue to have an absence of a bounce. We continue to have lower highs and lower lows. And the next move, the probability is just based on what you can see there, the probability is a move to the downside. If that happens, that will not be good for uranium stocks. So I don't think this is a sector that one can have a great deal of confidence in just at the minute. It doesn't mean that it's going to fall, but it's not showing signs where there's an attractive reward for risk to the upside. And there's the crude oil chart. We did dip during the week and recovered a bit late in the week, but the end result was it still finished down. Wrapping things up, there is just so much going on at the moment. Flexible thinking is absolutely critical. The US election outcome is almost certain to set numerous new trends across all asset classes. So you do not want to be sitting there with a fixed view. And just to pick one example of how unpredictable things are. If we look at gold, for instance, and I'm not supporting Trump or picking on Trump, I'm just using gold as an example, but under Trump, it's highly likely that we're going to get higher bond yields, higher inflation because of what he's going to do with tax cuts and with spending. And that means a higher US dollar. So that would be negative for gold, but it would be offset by the geopolitical reality, and the debt issues would be positive for gold. So what is the net result for gold? The answer is, I don't know. And I really don't want to think about it because I don't want to get a fixed idea in my head that gold is either going up or down. It's far better to just manage risk. Far better. So avoid fixed thinking is probably the best advice I can leave you with from this week. Now, portfolio analyst coming up this week is going to be taking stock of all the things that we talked about in the analysis that was done during October. So that's always a good learning forum. And also we'll be addressing the process of trading setups in detail, how to go about selecting the stocks, how to recognize the higher probability entries, and an exiting methodology that is going to work in your favor. So that's portfolio analyst coming up this week. And it's going to be early as well. It'll occur on Monday. I will be having a little stint in hospital. And as a consequence of that, there'll be no Sunday video next week. Okay, there's more information on the website. There is my email address, and I'll be back with you in a couple of weeks. Cheers.